Welcome to the Personal Finance Podcast for Doctors. This podcast aims to simplify all aspects of personal finance and helps you make smart and informed choices about money so that you can live happier and stress-free lives. Today's episode is brought to you by Chanda Verma, who is a financial coach with the doctor practice at MFA, the only company in India having a dedicated practice for doctors.
Hello everyone, welcome to this episode of the Personal Finance Podcast. Today we are going to talk about the most buzzed word in the market, fall, correction, whatever you may want to call it. So the title for today is It Never Seems Like a Good Time. Either it's too high or it's crashing. Let's see how good our history has been. In 2020 January, Sensex was at a 40,000 level. Then COVID hit and Sensex fell. Yet by mid-2021, we touched 50,000 level. And by end of 2021, we were at 60,000. Now, in 2022, almost the whole of 2022, we stayed below 60,000, but we hit the 60,000 mark again by December 2022. The entire 2023, we have been above 60,000, touching 70,000 by end of 2023. We have been above 70,000 for the whole of 2024. And we hit a new high of 80,000 around August 2024. And now again, we are back to below 80,000. But now if you think back, in 2020, when markets touched 40,000, what did we say? Markets are high. In 2021, 50,000, what did we say? Markets are high, don't invest, wait and watch. In 2022, 60,000, markets are high, don't invest, wait and watch. In 2023, 70,000, markets are high, don't invest, wait and watch. 2024, 80,000, markets are high, don't invest, wait and watch. The journey from 40,000 to 80,000, which happened in last 5 years, it wasn't a straight upwards line. Now it looks that way, but when we were going through that period, the market slipped and moved back. No one could time it. People waited for a bubble burst and they are still waiting today. Today we are at 70,000, 76,000 and this is like a new low. 60,000 would be disastrous, but it wasn't that way back then. So today markets are correcting. Isn't that good news? Isn't it an opportunity to invest? Because 5 years ahead, 80,000 will look like a new low. See what happened in last 5 years. A global pandemic, Russia invading Ukraine, the highest inflation of last 4 decades, several interest rate hikes, a banking crisis threatening to take down the financial system, the forecasted collapse of US market and even US dollar, war in the Middle East, US-China geopolitical conflict, US presidential elections and so many other things. The truth is, it never seems like a good time to buy because when the stock markets are going up, they can always correct, so it feels right to wait instead of buying. And when the stock markets are going down, they can always go down more, so it feels even more right to wait instead of buying. And the best part is that there will always be reasons for stock markets to go up or go down or to correct. The one forecast which I can see that is likely to remain consistent over the next 10, 100 years is this. 2025, markets will correct, don't invest, wait till things settle. 2026, markets are high, wait till things settle. 2030, markets are high, wait till things settle, and so on. We will see a repeat of several other things next 5 years. See, history is one damn thing after another. But as we have seen throughout history, forecasts are useless in general because no one knows a thing about the future. The point is, no one knows a thing about where the stock market is headed. Yes, you can sound intelligent, have a conversation, but you still don't know. Despite all that is happening in the world or will happen in the future, the truth is that the stock market usually, not always, goes up. And it has done so this year too. While the Indian stock market went up too fast, the Sensex now, as on end of December 2024, was up about 8 to 9% for the year. But why is the market going up? or correcting but still going up. It's not because they feel like going up. There's a fundamental reason. The earnings growth, the companies in the stock market. Earnings are the most important driver of stock prices. In simple words, earnings drive stock prices and the stock market. There are three important things to note here: the company's earnings, the future expectation of these earnings, and the uncertainty of these future expectations of earnings. There are countless variables at play in terms of these future expectations and the uncertainty of these expectations. This time around, India's GDP growth slowed to 5.4% in the second quarter of 2024-2025, down from 8.1% in the same quarter last year and 6.7% in the previous quarter, making it a 7-quarter low. Meanwhile, the corporate earnings for the same second quarter, July to September 2024, showed a modest increase. Net profit growth of 6.1% compared to 27.4% growth during the same period last year. But as we have seen time and again, the managers and executives of these companies will do whatever needs to be done to protect their earnings and thus their stock prices. They will do things such as pivot their strategies, raise prices, cut costs, change leadership, conduct share buybacks, and several other things. Just in anticipation of a recession, not even an actual one, companies like Google, Meta, many others, they laid off several thousand people simply to protect earnings. Google parent Alphabet laid off 6% of its workforce as it grappled with economic uncertainty that hit the company's bottom line in 2023. The point is that executives, managers, companies, they're not going to simply sit and do nothing. They will take steps to protect earnings, their margin, their growth, and any long-term move in the stock markets can thus be explained by the underlying earnings of companies and expectation and uncertainty around these expectations. It's not going to be a doomsday soon. So 2025 is going to be no different. There will be a lot happening in 2025. But here's the thing, it's a roller coaster. And a roller coaster doesn't really care about your short-term screams. The markets have its up and down, sure. But in the grand scheme of things, it keeps chugging along because companies and people behind them are pushing forward no matter what. Now, I'm not saying that the markets are immune to bad days. We have seen it. We have seen hits. It's like a boxer. It takes a punch, it stumbles, and eventually it gets back. And over time, it's those comebacks that really count. Let's not get caught up in the daily gossip of the market predicting the next big thing. Our focus should be on the long game, investing with a cool head, based on solid facts and not just the mood of the moment. So as we have stepped into 2025, remember that the market is all about looking ahead. The stock market, it seems like you can understand them backwards and with backtesting, yes. But the reality is that the stock market must always live going forward. And while no one can promise smooth sailing, we simply need to stick to our plan, focus on things that matter along with things that we can control. I hope this all makes sense to you. Do write back to us, do call us, and have a good day. God bless.
You were listening to the Personal Finance Podcast for Doctors with Chanda Verma. If you find this podcast relevant and interesting, do share it with other doctors as well. It will be great if you leave a review, share, like and subscribe. You could also let us know if there is any specific topic that you would like us to cover. For any queries or help, you can get in touch with MFA's Doctor Practice Team at 892-800-6140.